What's the minimum credit score you need to qualify for a mortgage? What score do you need to get the best interest rate available? And what can a listener named Miguel teach us about finances and life? We'll answer these questions and more on this, the 72nd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, I spent the weekend on finance, as I always do that at the end of each month. I update a spreadsheet that I maintain of our investments. I use Personal Capital, and I check that, throughout the month. But at the end of the month, it's just been a habit I've developed and done this for years. I have a spreadsheet, and I update the numbers for that new month for our investments, and then look at asset allocation. And I did that this weekend as we ended the month of May. And because the market has been doing quite well, I expected that my allocations would have drifted from my plan, and in fact they had. And so spent the weekend trying to figure out exactly how I wanted to rebalance. I did an episode on this show about rebalancing, and I'll pull up that number here in a minute as I look forward to my spreadsheet. But, here we go. It's podcasts 51 and 52. I did two of them. So DoughRoller.net/podcast 50 and podcast 51. But I tell you, the thing is about rebalancing, it can be a real puzzle to figure out the best way to do it. Particularly if, I think like a lot of us, you have a number of different accounts. So we have a 401ks at Fidelity, and we have an IRA at Vanguard, and then we have a SEP IRA. Then my wife has a 403b. And of course, between the 401ks on the one hand and the IRAs on the other, we don't have access to the same investments. And you might want to increase, whatever, say your exposure to REITs, real estate investment trusts, but you don't have the money in the account that currently holds the REITs to do it. So you've got to do it in another account, which means now opening up and investing in another REIT fund in a different account. And I do wish it were easier. I guess that's some of the benefits of a service like Betterment. Of course, in the case of a 401k, you can't use that service. But I spent the weekend trying to figure it all out, and I've decided I need to take some steps to simplify things. So, for example, I'm planning on rolling over my SEP IRA into our regular IRA. I don't know if you're aware that you can do that. When you think of rollovers, you think of moving something, say, from a 401k to an IRA, but that's not the only rollover. You can roll over a SEP IRA to a regular IRA, for example. And in fact, if you subscribe to the newsletter that goes out Saturday, I actually linked to an old post of mine that has a reference to an IRS chart that shows you all of the different combinations of rollovers that you can do, the ones that you're allowed to do, the ones you're not allowed to do. And so if you got the newsletter, you'll see that. If you didn't, shoot me an email. I can send you a link to it. But in any event, it just occurred to me that combining my SEP IRA into my regular IRA will make managing the investments much easier. And in fact, I'm considering then rolling that IRA into an individual 401k. And there are a lot of reasons for that go beyond just management. Maybe I'll cover that in a future podcast. But spent a good number of hours working on that this weekend, and in fact, again, the portfolio had drifted. I have some exposure to commodities, and that drifted down, as commodities haven't done as well. Interestingly, my foreign investments, developed markets and emerging markets, had drifted up more than I had realized. And so I had to make some adjustments there. And I'm still not done, so that's going to take me a little bit of time. But that was my weekend as I tried to sort through that. In today's podcast, got a couple of emails, I guess a reader mailbag, so to speak. Or listener mailbag, I guess I should say. I'm going to cover a couple of emails, have a tool of the day that I'm going to mention that I've just started to use. Still haven't decided if it's something I'm going to keep using, but I'll mention that to you. And then we're going to dive into credit scores and buying a home or refinancing. What credit scores do you need? What credit score do you need to get the best interest rate? And what scores do lenders use? So we're going to talk about that today as the main topic of the podcast. So let's get to the reader mailbag first. So a couple of folks actually emailed me in the last week. One named Steve, who said, he listened to podcast 69, DoughRoller.net/podcast 69, which was sort of my take on Dave Ramsey's endorsed local providers as they relate to investing. And I called them ELPs. ELP. Well, I got it. Steve and I think a couple others said, he doesn't actually call them ELPs, which I don't blame him. I guess he just refers to them as ELPs. So as I thought about that, I thought, well, that's great because I'm not going to go back and edit that podcast. I'd basically have to redo it, and I'm not going to do that, which means I'm going to be getting email for the next 10 years from folks who listen to it for the first time, and they say, Mr. DoughRoller, that's ELP, not ELPs. I may stick with ELPs, though. I like it. It's got a ring to it. Maybe I'll give Dave a call and see if he wants to change how he refers to his endorsed local providers. But anyway, I appreciate it. You guys keep me honest. And speaking of that, speaking of keeping me honest, I got another email from Richard, and he wrote, in 2 of the last podcasts, you talk about federal student loans, and you mentioned that subsidized loans had different rates from unsubsidized loans. As a former financial aid professional, I wanted to clarify that the rates for both types of loans are the same. The only difference is that the subsidized loan doesn't collect interest while the student is going through school. However, after graduation, during repayment, the rate is the same. Well, I appreciate that from Richard, and I wanted to share that with everybody. I did some quick research, and in fact, I haven't actually responded. At the time of recording this podcast, I have not responded to Richard's email. I actually will be doing that as soon as I finish this podcast. I did do some research, and it looks like one of the other factors, and by the way, I'm almost 50, so it's been a while since I've had to worry about subsidized and unsubsidized loans, although I had my share of them, that's for sure. But I guess part of it also depends on when the funds were distributed or dispersed. So I'm going to follow up with Richard on that, and if there's any additional info, I'll share it with you. But I wanted to share that from Richard, who obviously has an expertise in this area. And so again, Steve keeps me honest on how to say ELPs, which is ELP, and Richard keeping me honest on subsidized versus unsubsidized loans. And I really appreciate those emails. Don't hesitate to email me if you want to clarify something I've said. You think I just made a mistake. I mean, in some ways, I'm the guy behind the mic, but we're all in this together trying to make the most of our money, and I certainly don't get it right all of the time. So I really appreciate those emails, and I don't hesitate, obviously, to share them with you because I want to get you guys the best information I can. Okay, that brings me to the third and final email I want to share from a reader named Miguel. He writes, and just to put this email in context, as part of my podcast 69 on ELPs, I asked folks for their, if you've ever dealt with an endorsed local provider, shoot me an email, let me know what your experiences were like, how it went for you, if you liked them, you didn't like them, whatever. And I got a number of emails from folks on that. And by the way, keep sending those in. Love to hear your experiences on that. But here's what Miguel wrote. He said, my wife and I met and ended up working with one of his ELPs. He put us in A shares with American funds. Let me stop there. If you haven't listened to the podcast 69, an A share is a share that has what's called a front-end load. Basically, it's a fee. So it's usually 5 3/4%. So you just pay that right up front, right off the top. So if you were going to, for example, roll over $100,000, say from your company's 401k into an IRA that was invested with A share mutual funds, you would pay $5,750 shaved right off the top, and you'd invest the rest. And that's what an A share is. And American Funds is a mutual fund company that sells these called front load funds. And back in the day, I bought front load funds. I didn't know any better. But in any event, let me keep reading Miguel's email. He says, We were with him for about 2 years. Later, I found out that he wasn't upfront with the fees and commissions he was making from us. Overall, it was a negative experience, and we wasted money and time. Now, let me stop there. His next sentence is the most important. But before I get to it, I want to say, as I mentioned, I did the same thing. All of this is a learning process. We're all going to make mistakes with investing, with personal finance, debt, whatever. And one of my first mutual funds was just like Miguel was. I didn't have a broker, but actually I made a worse mistake. I got the worst of both worlds. I paid ridiculous upfront fees, and I didn't get at least some kind of benefit from some sort of financial advisor. So that was really bad. But it was the last sentence in his email that I think really hit home for me. So after all of that, we worked with an ELP, didn't like it, wasn't a good experience, a lot of fees, he writes. Ultimately, though, I blame myself since I didn't do proper research and take the time to educate myself. Boom. I think that is critical. I think that's the right attitude to have. Really, whenever we make mistakes, and even if we think someone else didn't deal with us the way they should have, if we don't take the approach that he did, we're not going to learn from it, and we're not going to learn to make better decisions going forward. And so I think that is fantastic. And I do the same thing. I try to do the same. Sometimes you can't. Sometimes you just get so frustrated, right, in life, whatever. But I try to do that with my business or my investing. If something goes wrong, I ask myself, okay, what could I have done differently? Yes, maybe someone else was at fault too, and maybe someone else did something that I didn't have control of. But still, what can I learn from that experience so that I can do better next time? And that's what he's done. And I suspect over the long term, he'll do very well, and he'll benefit greatly from having that attitude. And it's hard to have that attitude sometimes, when you feel like someone hasn't treated you fairly or the way they should have. And this isn't to beat up on endorsed local providers. It's really goes far beyond commission-based brokers. It really can apply to just about every aspect of our life. It's how we learn and get better and improve and make progress. And I think that's an excellent attitude that he's taken in that circumstance. Okay, our tool of the day is one that I've just started using, and it's Oyster Books. Actually, let me make sure I've got that right. Yes, oysterbooks.com. It's sort of the Netflix of books. So the idea is you pay about $10 a month, and you get unlimited access on an e-reader, your iPad, whatever, to, I think they have about 500,000 books in their library right now. And you can start with the free month, 30 days for free, which is what I've done. I'm kind of evaluating it. One of the things here has been I'm trying to balance. I don't really want to I read a lot of books. I don't want to spend a fortune on books. So one of the things I've been doing, of course, is going to our library. And that's helpful, except that, we have a great library in Northern Virginia, really a phenomenal library. But there's tons of things that I want to read that aren't available. The library just doesn't have them. And so I'm trying to balance, getting access to the information I want to read, the books I want to read, and not paying an arm and a leg. So I don't know if Oyster Books is going to be the answer for me. But I'm giving it a try. As I said, they have a 30-day free trial. And I'm reading a book now on basically portfolio construction, asset allocation, as applied by large educational foundations. And maybe I'll talk about, in fact, I will talk about that in future podcasts. I know it sounds exciting, right? Well, I think it's kind of interesting, but I may just be odd in that regard. But in any event, Oyster has all kinds of, obviously fiction, nonfiction, all kinds of great stuff. So I'm giving it a try. If you've been using it, shoot me an email, dr@DoughRoller.net. Let me know what you think of the service, if you think it's worth it. I was looking at their blog, and they actually had a review of a book by Jess Walter, who I'd never heard of, called The Financial Lives of the Poets. It's a fiction, and it's a book that I'm going to go ahead and I'm definitely going to read. It looks quite good. And so I'm gonna give that a read. One of the things, I guess they pulled out quotes from this book, and the main character is a guy named Matt. And one of the things he says is, anything you try to own ends up owning you. We're all just renting. But that's actually quite powerful, I think, and we can learn a lot from that. So anyway, Oyster Books, that's the tool of the day. If you've used it, let me know what you think. I'm going to give it a try. I am. and I'll let you know what I think in a future podcast. But so far, so good. We'll see if I think it's worth the money. That's really the issue for me. Okay, on to the main topic. 3 questions. We're going to answer 3 questions today, and then we're going to be done. Credit score needed to buy a home, credit score needed to get the best rate, and which credit score do lenders actually use? So let's start with question number 1. Credit score needed to buy a home, to get a mortgage. Now, as you would expect, there's no sort of easy answer for this. Why? A couple of reasons why. One, there are different mortgage programs. You've probably 3 of the largest that I can think of: FHA loans, VA for veterans, and then what you might just think of as conventional loans, which are sort of are mortgages that ultimately get they're not FHA, they're not VA, but they ultimately get sold to Freddie and Fannie, and as a result have to meet the standards that Freddie and Fannie require, and so those are called conventional loans. So each of these loans can have or programs can have different credit score requirements. So there's not one answer to this question. That's the first thing to note. The second thing, and this one is I think may surprise some folks, is that credit scores vary from bank to bank, even when, for example, they're writing FHA loans. So, for example, FHA may come in and say, all right, to qualify for a mortgage with a 3.5% down payment, which is what sort of the FHA program is known for, a relatively low down payment, FHA may say, okay, they have to have a FICO score of 580, and which is what they require for that 3.5% down payment program. That doesn't mean, though, that every bank that offers an FHA loan has to offer the 3.5% down payment loan to folks with 580 or better. In other words, they can have more strict standards. They can say, yeah, FHA, they say 580, but you know what? We're not going to actually give this loan out to anyone with a score under 640. And so the requirements, even if the underlying program would permit the loan, it doesn't mean that a specific bank has to offer the loan, the mortgage, under those terms. So that kind of complicates things more. The requirements can vary from bank to bank. The third thing that kind of muddies the water a bit is that your credit score is related to the down payment that's required. So, for example, the larger the down payment, you might be able to get away with a slightly lower credit score, right? And again, I'll use FHA as an example. You can qualify for an FHA loan with under the FHA guidelines with a credit score of, I believe it's 500, but you won't qualify for the 3.5% down payment. I think at that level, if you're at 500, between 500 and 580 or 500 and 579 under the FHA standards, you have to have a 10% down payment. And the same can be true for conventional loans. Depending on your credit score, your down payment can affect credit score requirements. If you're going to be able to put 20 or 30% down, a bank might let a lower credit score qualify. But if you want a 10% down payment on a conventional loan, the bank is likely going to have more stricter credit score requirements. So I know muddies the water. We wish it were an easier answer, but it's not. Now, that being said, I can give you some general rules of thumb. For an FHA or VA loan, you're generally, I mentioned that for FHA, 580 for a 3.5% loan, but when you go to banks, what you're probably going to find is a requirement of a credit score of at least 600. Now, did a little research in advance of the podcast, and that is something that has recently changed. The minimum that most banks were requiring for that 3.5% FHA loan was 640. And earlier this year, they dropped it, or some banks dropped it. I think Wells Fargo led this, from what I can tell, and dropped it 40 points to 600. Now, you might be saying, well, wait a minute. If FHA program allows 3.5% loan at 580, why do these banks require what was 640 now is 600? Why do they do that? And I think, as best as I understand it, and I'm not a mortgage expert, I've had a fair number of mortgages, including on real estate investments. But when someone defaults, even on a FHA-backed loan, it affects the bank, and in a number of different ways. So the bank is absolutely concerned with default rates. even if they're even selling a mortgage, they may have to be forced to buy it back, for example, or it could impact their relationship with these mortgage programs. So they absolutely care about defaults. And so while they may be permitted under a program to make a mortgage with, say, a certain credit score, that doesn't mean that they will. They may require stricter requirements, as they do, to protect themselves. So again, today, FHA loans, VA loans, typically what I'm reading, you can find them with credit scores of 600 or higher at the right banks. As I mentioned, it dropped from 640 a few months ago, which underscores something important to understand, and that is these numbers change over time. And so, ultimately, the best way to find out is to start contacting banks and brokers and finding out what their requirements are. But that's what I've seen from a lot of banks, again, led by Wells Fargo. Right now, credit score 600. Now, what I've read for conventional loans is that you really need a credit score of at least 620. But again, that really depends on the down payment. So if you're wanting a smaller down payment, what I've read is you're really looking at more like 660, 680 requirements if you're looking for a smaller down payment. Now, again, just like with FHA loans, this is going to vary from bank to bank. It's going to change over time. But that is sort of the rule of thumb that I have seen and read about in my research in advance of this podcast. So one thing I would love to know is if you are listening and you've recently refinanced or you've recently obtained a mortgage, you've been through this process and you've no doubt talked to the folks. I'd like to hear from you. What were they telling you? I mean, this really is a kind of situation where you really need real-time information because it changes. And so if you've experienced that recently, gone through a refinance or obtained a mortgage, let me know what you were seeing out in the real world on these numbers. But that's the best information that I have today for you on what would be required sort of as a minimum to qualify. Now, that gets us to question 2, because just because you qualify for a minimum score or qualify with a minimum score doesn't mean, in fact, you won't get the best interest rates. If you walk in and can qualify for a conventional mortgage with, say, a credit score of, let's say, 650, you will absolutely not get the best interest rates. And that raises the question, all right, well, what do you need? And not only what do you need, but does it make a big difference? Huge difference. So my best information here comes right from my FICO. And a link to this will be in the show notes. So what they say is for the best, to qualify for the best available interest rate on a mortgage, and this is generally for a conventional loan, you need a credit score of at least 760. 760. Now, at today's rates, that would qualify, again, these are just national averages, qualify you on a 30-year fixed rate mortgage for at a rate of about 3.75% would be your rate. Now that's again with a FICO score of 760 or higher. Now, the great thing about the MyFICO site is that they show you different ranges of credit scores and then how the interest rates go up as your credit score goes down. I won't read through them all, but if we start at 760, that's 3.75%. Let's go all the way down to the lowest credit score they list, which again, 620, conventional mortgage 620. Your rate is 5.35%. That's a huge difference. It may not at first blush seem like a lot, but when you apply that against a $200,000 or $300,000 or perhaps more home, and then multiply it over 30 years, you're talking about a small fortune. So to get that best interest rate, you're really looking for a FICO score of 760 or higher. And it really matters. It really matters to how much your monthly payment's going to be, how much you can qualify for, how much interest you're going to pay over what could be up to 30 years on a mortgage. And so if you're looking to buy a home or refinance, it's really important to know what your credit score is and to work on improving it. Done some podcasts on that. You've probably listened to them, but for those listening that haven't, I would start with podcast episode 2. So that's DoughRoller.net/podcast number 2, podcast 2, I interviewed Tom Quinn of FICO. I mean, he is the credit expert. And I think that probably is where I'd start. A lot of great information in that podcast. I'd also check out podcasts 17 and 18, podcast 17, podcast 18. Again, DoughRoller.net/podcast17, and then DoughRoller.net/podcast 18. Episode 17 was sort of Credit Scores 101. I kind of gave an overview of how they're determined, how you can improve them. And then in podcast 18, I interviewed Maxine Sweet. She's a credit expert at Experian, one of the 3 major credit bureaus. So between those 3 episodes, you really should have, I would think, just about everything you need to understand credit scores and to improve them. But obviously, if you have questions, don't hesitate to shoot me an email. But man, boy, when it comes to refinancing and getting a mortgage, credit scores are critical. They make a huge difference in how much you're going to pay for a mortgage, how much your monthly payment's going to be, how much you're going to pay in interest over the life of the loan. Critical. All right, question 3. What credit scores do lenders use? As you may know, there are 3 credit bureaus, so most people have 3 FICO scores based on 3 sets of data from these 3 major credit bureaus. There's typically not a huge disparity from one to the next, but there are differences, and those differences can matter when you get a loan, a mortgage. And what about if you're married or you're buying a home with someone else? You got not only 3 credit scores, but that's now times 2. And so how does that work? What credit scores do the mortgage lenders use when there are 2 people applying for a loan? Well, some time ago, I actually dug into this issue in quite some detail, and went and looked up this information on Freddie and Fannie's websites, and it's kind of interesting the way they do it. So let's kind of break it down. Let's just first start with just a single individual applying for a mortgage. If you have 3 scores, and from the 3 credit bureaus, 3 FICO scores, and I should say they use FICO scores as opposed to other scoring formulas, and you have 3 different scores. They'll take the middle. They take the middle score. Throw away the top score, throw away the bottom score, they use the middle. Now, what happens if it just turns out that 2 of your scores are the same, which could happen, right? 2 of the 3 scores are the same. Then what do? They use that score, right? They use the score that's the same. And that's true regardless of whether the scores that are the same are the 2 highest or the 2 lowest. Doesn't matter. They just use that score. So that's how they do it with a single applicant. Now, what if there are 2 applicants? What if there are 2 of you going to buy a home? What do they do there? Well, the first thing they do is they determine which score to use on an individual basis, following the method that I just laid out. If all the scores are the same, are different, they take the middle score. If 2 scores are the same, they use that one. They do that for each individual applicant, and then they use the lowest of the 2, right? So it's sort of the weakest link kind of theory, and so that's why it's important. If you're married or you're looking at a joint application, you obviously want to focus on and pay attention to both FICO scores for both applicants, and work on improving both of them. And while it certainly helps to improve the higher person's score, just in general, in a case of a mortgage, it's not going to do you any good if the person with the lower score is not improving theirs as well. So that's how they do it with 2 applicants. And again, these sort of rules can change. So as you're applying for loans, applying for refinance, applying for a mortgage, you'll want to speak to your mortgage broker, understand the process, make sure that things haven't changed, because they do change from time to time, as I mentioned. And who knows, maybe the way they determine which score to use could change as well over time. And so it's important to understand sort of the current information as you're applying for the loan. But there you go. So that's the credit score you need to buy a home, generally. Again, it changes. You want to make sure you've got updated information. You know that the credit score you need to get the best rate, typically around 760 or better. And you know how they pick the credit scores, both for individual applicants and for joint applicants. how they deal with those multiple scores. As always, if you've been going through this process recently, would love to hear from you, learn your experience. And actually, I should say this too. I've reached out to a number of listeners who've, they've emailed me, and I get into email conversations back and forth. And I'm really excited that I'm going to have some of you on the show. I've got a couple already lined up. Haven't recorded the podcast yet, but they're going to talk about real life finances, what they're doing to invest, what they're doing to save, what their approach to budgeting is, and what works for them, what doesn't. Couples, and how do they deal with differing views on money and finance. And so if you've got a great story to tell, maybe it's a success story, maybe you're not there yet, but you're making good progress, or maybe you've just got some tough questions and you'd love to come on the show and talk about those finance issues. I'd love to have you on the show. Like I said, gonna have a few folks on the show here later this month. But if you think it's something you might be interested in doing, shoot me an email at dr@doughroller.net. Would love to chat with you about that possibility. I promise you, it's painless. And you can always wait to hear how the first few interviews go if you want before you shoot me an email, but would love to hear from you. Hey, for this show, you can get the show notes at DoughRoller.net/podcast72. That will actually take you to an article I wrote some time ago on this topic that I've updated for this podcast. It will include a lot of links to a lot of the things I've talked about, including links to my FICO and Freddie and Fannie, and a lot of great resources so that you can follow up on all this stuff if you want to. So you'll find that at again DoughRoller.net/podcast72. And as always, don't hesitate to email me. As I've said before, I read and respond to every single email. In fact, I'm going to be responding to Richard's email in just a moment. But I really do. I really read every single email. I enjoy hearing from you. Whether it's a question, a comment, a topic, a correction because I've said something stupid, which happens. But I love to hear from you, so don't hesitate to email me at dr@doughroller.net. Hey, remember, until next time, the best thing money can buy is financial freedom.